Hi, we're going to walk through some examples for exam 2, their practice problems. We're going to kind of walk through the answers. So first, Peterson Company estimates that overhead costs for the next year will be $6,520,000 for indirect labor and $550,000 for factory utilities. The company uses machine hours as its overhead allocation base. If 140,000 machine hours are planned for this next year, what is the company's plant-wide overhead rate? Well, the formula is going to be fixed costs or estimated fixed overhead divided by whatever the base is. And for this example, it tells us it's machine hours. So we would look at the indirect labor, $6,520,000. We're going to add the factory utilities. Both of those are overhead. Then we're going to divide it by 140,000 machine hours. When we do that, we get an overhead rate of $50.50 per machine hour. Now note, this is based on estimated or planned or budgeted. If it gives you the actual, that is not used in calculating the overhead rate. This is also called the predetermined overhead rate. So on the second one, a company uses activity-based costing to determine the cost of its 3 products A, B, and C. The budgeted cost and activity for each of the company's 3 activity cost pools are shown in the following table. So to calculate the activity rates, we need to determine the total activity, and then we have the budgeted costs, and it's the cost of doing that activity one time. So we have the 3 activities listed here, the budgeted cost, and then the 3 products. So first we're going to add up the number of times that activity is going to be performed in total. So 6,000 plus 9,000 plus 20,000 is 35,000. So I've done that for each of the activities. Then we're going to take the budgeted cost for activity 1 at 70,000 divided by the number of times that activity is going to be performed to determine the activity rate. So the answers are $2, $1.50, and $16. On 3, a firm expects to sell 25,000 units of its product at $11 per unit and to incur variable cost per unit of $6. Total fixed costs are $70,000. The contribution margin is. So to calculate contribution margin, it's sales minus variable costs. So we can do this by multiplying them out, or we can do it as I did here on a per unit basis times the number of units. So we're going to sell them for 11, and we're going to subtract the variable cost of 6. So we get a contribution margin of $5 per unit. This is the amount that contributes to covering your fixed overhead. We're going to multiply that times the number of units of 25,000 units, and we get a total contribution margin of $125,000. Using the same example, it asks us for the pre-tax net income. To determine that, we're going to take sales minus our cost to determine net income. So we have sales, the number of units times the selling price, 275,000. Variable cost is the number of units times the variable cost of 20 or 25,000 in total. And we're going to subtract our fixed costs to determine the net income of $55,000. On 5, a company has fixed costs of $320,000 and a contribution margin per unit of $15. If the firm wants to earn a target profit of $40,000 pre-tax income, how many units must be sold? The formula for that is going to be fixed costs, $320,000, plus your target profit or your desired net income of $40,000. You're going to divide that total by the contribution margin per unit of $15 to determine that the break-even point would be $24,000. We would have to sell that many units to generate that much pre-tax income. On 6, Watson Company has monthly fixed costs of $83,000 and a 40% contribution margin ratio. If the company has set a target monthly income of $15,000, what dollar amount of sales must be made to produce the target income? So we're going to take our fixed cost plus that target net income, and we're going to divide this by the contribution margin ratio of 40%. So that tells us that we need to sell $245,000. On 7, use the following information to determine the break-even point in units. So we're given the sales in units, selling price, variable cost, and fixed costs. To calculate the break-even point, it's going to be fixed cost divided by contribution margin. So we can calculate the contribution margin. By definition is the selling price minus the variable cost. For this example, $7. Then we're going to take our fixed cost of $186,000. We're going to divide it by the contribution margin per unit. Our break-even point is 26,571 units. On number 8, Bingle Company provides the following sales forecast for the next 3 months. So we're given sales for July, August, and September. The company wants to end each month with ending finished goods inventory equal to 25% of the next month's sales. Finished goods inventory on June 30th is 1250. The budgeted production units for July are. To calculate production, it's basically going to be what you plan to sell plus your desired ending inventory minus your beginning inventory. So we have July sales of 5,000 units. Our desired ending inventory is 25% of August. So we take 5,700 times 25%, we get 1,425. And then we subtract our beginning inventory, the amount that we already have, which is given at 1,250. So we calculate our production as 5,175 units. In the last problem, Alliance Company budgets production of 24,000 units in January and 28,000 units in February. Each finished unit requires 4 pounds of raw material K that costs $2.50 per pound. Each month's ending raw materials inventory should equal 40% of the following month's budgeted materials. The January 1st inventory for this material is 38,400 pounds. What is the budgeted materials need in pounds for January? So again, it's basically kind of the same formula when you're calculating these. You're going to calculate the amount that's needed for the month. So this would be production of 24,000 units times 4 pounds each, 96,000 pounds. Plus we're going to add desired ending inventory. By definition, that's given to us as 40% of the following month's budgeted materials. The following month's budgeted materials is 28,000 for February. So we're going to take 28,000 units times 4 pounds times the 0.4, the 40%, and we get 44,800. Then we're going to subtract the amount that we have in beginning inventory. That's given to us as 38,400 pounds. When we add those two together and subtract our beginning inventory, we get 102,400 for budgeted materials in pounds.